Welcome to This Explainer. Today, we are building a literal blueprint to take you from financial anxiety right to absolute empowerment. Look, we all want financial security, right? But just, hoping for a lucky break? That's not going to cut it. You need a structured plan. So we're going to break down the mechanics of money management using a super simple metaphor, building your financial house. Let's get right into it.
So let's kick things off with a pretty stark reality. That traditional timeline of working comfortably until you're 65, that is fundamentally changing. Automation, shifting global economies, even just cyclical industry downturns, they are actively shortening our predictable employable years. If you don't upskill or if your industry hits a recession, you could find yourself out of the workforce way earlier than expected. And that makes taking absolute control of your financial timeline not just a good idea, but incredibly urgent.
And well, that brings us right to the core of personal finance. Forget all the complicated jargon you hear. At its heart, personal finance is literally just the management system you use to budget, save, and spend. But more importantly, it's your roadmap for navigating those exact economic uncertainties we just talked about. It's how we account for future life events and, those totally unpredictable financial risks.
To keep this from getting overwhelming, this explainer is going to build your financial house in 4 logical steps. First, the foundation, then the walls, the roof, and finally, the fence.
All right, starting off with step 1, the foundation, assess and control. Every strong house needs a rock-solid base, right? And the absolute golden rule of building yours is this: always pay yourself first. Instead of treating your savings like an afterthought, just crossing your fingers that you've got a few bucks left over at the end of the month, you've got to treat your future self as a priority. The absolute easiest way to do this? Literally set up automatic deductions straight from your paycheck into a savings or investment account before you even see the money. Out of sight, out of mind. But here's the thing. To know exactly how much you can pay yourself, you have to know your starting point. You do this by creating a net worth statement. It's like a financial snapshot. On one side, list your assets, everything you own, cash, investments, real estate. On the other side, list your liabilities, everything you owe, so credit cards, student loans, mortgage. Subtract what you owe from what you own. Honestly, whether you have a positive or negative net worth right now doesn't matter. What matters is having a clear, honest baseline to improve upon. Because, well, you can't navigate to your destination if you don't know where you're starting. Okay, so once you have that baseline, you need a system for your daily cash flow. Enter the brilliantly simple 50-30-20 rule. Instead of agonizing over every single coffee receipt, just look at the big picture. Allocate 50% of your take-home pay to essential needs like housing and groceries. Give 30% to your wants, because let's be real, a budget has to be realistic to actually be sustainable. And finally, put that remaining 20% strictly towards savings and paying down your debt. Now, if you're struggling to keep those wants under that 30% mark, try the 24-hour rule. Whenever you get the impulse to buy something non-essential, like, that ridiculously expensive smart toaster you saw online, force yourself to wait a full 24 hours. Usually, the desire just completely fades. Combine that trick with cutting out small, repetitive expenses, and you are going to be shocked at how fast your money actually grows, thanks to the power of compound interest. Moving right along to step 2, the walls, your safety net. So your foundation is poured, your cash flow is under control. Now, we need walls to keep you safe from unexpected storms. A huge part of securing those walls is dealing with existing burdens, especially student loans. It is absolutely critical that you balance managing that student loan debt efficiently while simultaneously funding your other long-term goals. Seriously, do not put off saving for retirement or house down payment just because you have student debt. You really need a dual-track approach so your financial timeline doesn't just stall out. You also absolutely have to build a dedicated emergency fund. Look, financial crises do not politely wait for a convenient time. By setting up automatic transfers from your checking right to your savings, you effortlessly build a buffer for those unpredictable moments, whether it's a crazy medical bill or your car suddenly breaking down. Think of this emergency fund as, quite literally, the insulation in your walls. All right, step 3, the roof, saving versus investing. Every house needs a solid roof, and in this case, it protects your purchasing power from the quiet, sneaky erosion of inflation. To build it, we need to understand the fundamental difference between saving and investing. Saving is all about keeping your money safe and accessible, and it's usually federally insured. But the trade-off? It earns a super low wage. Investing, on the other hand, means taking on higher risk with no federal insurance, but, and this is a big but, it unlocks the massive power of compound interest and way better long-term growth. This actually requires a massive psychological shift. When you invest, like buying a stock, you stop being just a consumer. You literally become an owner of something. You are buying a piece of a real company, totally expecting that as the company grows and makes a profit, the value of your ownership share is going to increase over time. Now, to maximize that growth for retirement, you've got to use the right accounts. Let's slow down just a sec to look at the mechanics here. Traditional IRAs and 401ks use pre-tax dollars. That means they reduced your taxable income right now, but you will pay taxes when you take the money out later in life. Roth accounts, they operate in reverse. You put in after-tax dollars today, but your qualified withdrawals in retirement, completely tax-free. Choosing the right structure is absolutely vital for maximizing what you actually get to keep in your pocket. So the whole game here is tax efficiency. As researchers love to point out, costs matter to every bottom line, and one of the absolute largest costs for any investor, taxes. Efficiency is literally just as important as your returns. Think of taxes like a leak in your brand new roof. A stellar investment strategy can be completely undermined if you aren't paying attention to how much of your growth is silently draining away to tax liabilities. And finally, step 4, the fence, retirement and estate planning. Okay, so your house is built, but it needs a solid fence to protect your legacy and make sure your wealth seamlessly transfers to your survivors. You do this by running through a really strict organizational checklist. Write a clear letter of instruction for your loved ones. Update your life insurance so it actually reflects your current net worth. Set up a trust if you have minor kids who legally can't receive proceeds directly. And consolidate all your vital documents and verified beneficiary designations into one easily accessible place. This fence guarantees that everything you've worked so hard to build remains totally intact. I want to leave you with a somewhat provocative thought to chew on after today's explainer. Look at the investments you currently hold and ask yourself, are your market returns actually high enough to cover the taxes you are going to owe on them? And honestly, more importantly, from the foundation all the way to the fence, is your financial house finally in order?